So what's really happening in China right now? It's not just a temporary setback or a small dip in growth. China's economy is facing a full-blown crisis that could send shockwaves throughout the entire world. Let's start with the biggest problem: China's property market. The real estate industry in China has been a huge driver of its economy for years, but now it's collapsing under the weight of its own success. Over the last 2 decades, property developers in China have built countless new apartment buildings and entire cities, banking on the idea that demand would never slow down. People were eager to invest.
Shut up and take my money!
Believing that real estate was a surefire way to make money. But now, that bubble just burst. Developers like Evergrande, which was one of the largest property companies in China, are going bankrupt. They borrowed too much money, built too much, and now they just can't sell the properties fast enough to pay back their debts. It's a crisis that's affecting not only the developers of China, but also millions of Chinese citizens who invest their savings in properties that are now worth less than what they paid. Imagine putting all of your savings into a home, only to find out that its value has plummeted, and you're stuck with a mortgage that you can't afford. This is what millions of people in China are going through right now. And as the property market collapses, it's dragging down the rest of the economy with it. But the problems don't stop there. China's also facing massive deflation, which is when prices of goods and services start to fall. While that might sound like a good thing at first on the surface, it's actually a sign that the economy is in trouble. When prices fall, businesses start to lose money, which leads to job cuts and then lower wages. People stop spending, businesses stop investing, and the economy grinds to a halt. It's a vicious cycle that can be very hard to break out of. At the same time, the Chinese government is struggling to find a solution. They tried to stimulate the economy by lowering interest rates and pumping money into the system, but so far, it just hasn't worked. In fact, many experts believe that China's economic problems are structural, meaning that they're baked into the system and they can't easily be fixed with quick policy changes. So how did China get there in the first place? How did the once unstoppable economic powerhouse start to crumble? And more importantly, what happens next? To fully understand China's economic collapse, we need to dive into a few layers of the crisis, starting with the property market and expanding to another critical area, the stock market. As we mentioned, the property market in China has been a ticking time bomb. For decades, it was seen as a surefire way to build wealth, with property prices skyrocketing year after year. But when demand started to slow, the bubble began to burst, and companies like Evergrande collapsed under the weight of their massive debt. Millions of Chinese families who had invested their entire life savings into real estate found themselves stuck with properties that were unfinished, losing value, and in some cases, they were completely abandoned. This property crisis didn't just affect individual investors. It sent shockwaves throughout the broader financial system. Developers defaulted on their debts, and as they couldn't pay back loans, banks and financial institutions across China began to feel the squeeze. When a sector as large as real estate crumbles, the effects can spread quickly, and that's exactly what happened. But the real estate market isn't the only sector that's been struggling. The Chinese stock market has also faced serious troubles, leading to the government to step in with aggressive stimulus. For years, the stock market in China was seen as another area of fast growth and easy money. Companies listed on the Shanghai and Shenzhen Stock Exchange were growing rapidly, and investors were eager to get a piece of the action. However, the stock market, just like the property market, was way overinflated. Many companies were over-leveraged, borrowing huge sums of money to expand, but they weren't generating enough revenue to pay back their debts. As the economy slowed down, these companies started reporting weaker and weaker earnings, and investor confidence began to falter. Around 2024, the Chinese stock market entered a sharp decline. Major indices like the Shanghai Composite began to plummet, wiping out billions of dollars of wealth almost overnight. This was more than just a blip. Investors started panic selling.
Everybody panic! Oh my God!
Driving prices down even further. For the average Chinese citizen, this collapse felt like watching their savings disappear in real time. For businesses, it meant that they had fewer options to raise capital, which further deepened the economic slowdown. And here's where things get really interesting. To prevent a complete market meltdown, the Chinese government stepped in with a series of aggressive stimulus measures. They pumped billions of dollars into the financial system, buying up stocks to prevent them from falling even further. It was a strategy designed to prop up the market and restore investor confidence, but it came at a significant cost. Think of it like this. Imagine you're at a carnival and you're playing one of those games where you have to keep a balloon in the air by tapping it every time it starts to fall. Now imagine you're doing that with hundreds of balloons all at once. That's essentially what the Chinese government was doing with its stock market. Every time the stock prices started to drop, they tapped them back up with stimulus, but it wasn't a sustainable solution. And this wasn't the first time that the China stock market needed rescuing. Back in 2015, when the market faced another significant crash, the government also stepped in to stabilize it. They imposed rules to stop large-scale selling, bought up shares, and restricted short selling to artificially keep prices higher. But these interventions are like band-aids on a much deeper wound. They can only do so much before the underlying issues resurface. Despite the government's efforts, the underlying problems remained. Investors were losing faith, not just in the stock market, but in the entire economic system. Businesses weren't growing fast enough, debt levels were too high, and there was simply too much uncertainty. The lack of confidence led to even more selling, and it became clear that the government strategy of stimulus was only delaying the inevitable. Adding to the complexity, China's financial system is largely controlled by the government, which means when the markets are in trouble, the government has more direct control than in places like the US or Europe. This centralized control allows China to act quickly, but it also means that problems can be hidden from view for much longer, only to explode later in much larger ways. One of the other ways that China has tried to boost its economy is through lowering interest rates and cutting taxes to stimulate spending and investment. But while these measures helped in the short term, they haven't been enough to offset deeper structural problems plaguing the economy. It's like trying to fix a leaking roof with a bucket. It works for a while, but eventually the roof needs replaced. Even with all this intervention, China's stock market hasn't fully recovered. And it's likely that we'll continue to see more volatility as the government tries to balance economic growth with managing the financial crisis. Beyond the stock market, China is also grappling with significant issues of deflation. Prices for goods and services are actually falling, which might sound like a good thing, but it's actually a dangerous sign for the economy. When prices drop, people and businesses hold off on spending, expecting that things will become even cheaper. So they wait for the price to go down. This causes a cycle where less spending leads to slower economic growth, which leads to even more deflation. It's a vicious cycle that's very difficult to escape from. The result of all these factors combined, real estate collapse, stock market turbulence, and deflation, is that China's once booming economy is now grinding to a halt. And while the government has tried various tactics to reignite growth, the truth is that it's facing challenges that stimulus packages alone just can't solve. So why should you care about what's happening in China? You might be thinking, this is happening on the other side of the world. How does it affect me at all? But the reality is that China's economic collapse could have major consequences for the global economy, including right here at home. First, let's talk about trade. China is one of the world's largest exporters. And many of the products that you use every day, your phone, your clothes, your electronics, are made in China. If China's economy continues to collapse, it could disrupt the global supply chains, making it harder and more expensive to get the goods that you rely on every day. Prices could rise, and companies that rely on Chinese manufacturing might have to find new suppliers, which could take time and increase costs. But it's not just about the products you buy. China's economic slowdown could also have a major impact on global financial markets. Investors around the world are closely watching China's economy. And if things continue to worsen, we could see stock markets tumble and investment portfolios shrink. Even if you're not investing in the stock market right now, this could still affect you in the future, especially if you're planning to save for college, retirement, or a major purchase, like a home. Finally, there's the geopolitical angle to consider. China's economic collapse could lead to increased tensions between China and other countries, including the US. As China's economy weakens, the Chinese government may become more assertive on the global stage, leading to conflicts over trade, technology, and even military power. Right now they're circling Taiwan. These tensions could create uncertainty and instability in global politics, which could have far-reaching consequences. In many ways, China's economic collapse is a cautionary tale about the dangers of economic bubbles and the risks of relying too heavily on one sector for growth. Whether it's the housing market, the stock market, or even emerging technologies like cryptocurrencies, it's important to be mindful where you invest your money and to understand that what goes up must come down. So, what can we learn from China's situation? The most important takeaway is that no economy is invincible. Even the strongest economies can falter, and when they do, the effects can be felt around the world. As we watch China's story continue to unfold, it's a reminder to stay informed, stay cautious, and always be prepared for the unexpected. In the end, China's economic collapse isn't just a story about numbers and statistics, it's a story about real people, real businesses, and a global economy that's more interconnected than ever before. What happens in China doesn't stay in China. It affects all of us. Whether it's through the products we buy, the jobs we work, or the investments we make, we're all connected to what's happening in the world's second largest economy. Thanks for watching. If you enjoyed this video, please make sure to like, subscribe, and leave a comment below for the YouTube algorithm. Thank you so much, and I'll see you next time.